Hi, welcome back. The last session we talked about the first strand of value investing, which is screening for bargains, passive screeners. In this session, I want to turn to a second strand, which also has deep roots in value investing, which is to be a contrarian investor, a contrarian value investor. Lots of different kinds of contrarian investors, but I want to talk about contrarian value investing. All contrarian investing, though, is built on the same premise that markets overreact, that investors overreact, that human beings overreact to both good news and bad news. Consequently, what you're looking for as a contrarian value investor is a good company on which there's been some bad news. That bad news has pushed the stock price down, as it should, but it's pushed it down too much. And you're stepping in and buying the company at a bargain. In fact, if you look at all the mythical great investments made by great value investors, many of them are contrarian investing. And one example I can think of is Warren Buffett buying American Express in the early 1960s after a salad oil scandal. Don't ask me what the details are, but what happened was that there was a scandal which essentially affected American Express. The stock price got knocked down, and Warren Buffett stepped in and said, hey, I can buy this company for less than half of what they get in cash flows each year from just their credit card, or the green card, which at that time they had only one American Express card. So he essentially got American Express at a bargain, and the rest, as they say, is history. So the essence of contrarian investing is that markets overreact. And you have a pretty solid empirical rationale for it, right? There is evidence that markets do overreact. We saw some of that when we looked at the evidence on serial correlation a few sessions ago when we were talking about technical indicators, where we saw that if you looked at long time periods, 3 years to 5 years, that stocks that have gone up the most over the last 5 years are more likely to go down over the next 5. And the stocks that have gone down the most over the last 5 are going to reverse themselves. So whenever you see evidence of reversal, you're essentially seeing evidence of overreaction. And the same thing applies in individual stocks as well, if you take the stocks that have lost the most. In fact, the first piece of evidence we're going to look at is actually evidence that comes from studies of what are called winner stocks and loser stocks. Sounds fancy, but here's what these studies do. They look at the stocks that have gone down the most over the last year, the last 2 years, last 5 years. The time horizon is up to the study. And then they track whether investing in these stocks would generate returns for you going forward. In fact, one of the pioneering studies in this section was done by DeBont and Taylor. Richard Taylor was one of the founding fathers of behavioral finance. But DeBont and Taylor essentially went back from 1930 through to 78, and they created a very simple study. They looked at two portfolios. One portfolio was the 35 stocks that went up the most over the previous year, and the other portfolio included the 35 stocks that had gone down the most over the previous year. So let's call the first portfolio a winner portfolio because it's gone up the most, and the second portfolio the loser portfolio. Then they looked at what would happen if you bought each of these 35 stocks in each of these portfolios and track them for the next 5 years. And here's what they found. So this is by months. So the months run for 60 months. So one is a winner portfolio and the other is a loser portfolio. Guess which one's your winner? There's your winner portfolio. The winner portfolio actually ends up losing 11% over the following 5 years. And there's your loser portfolio, which over the next 5 years generates returns of almost 30%, 28%. In fact, the differential between the losers and the winners is almost if you add the two numbers up, is almost 40%, reflecting the fact that losing stocks did much better than winning stocks. Now, intuitively, a lot of people get this. They say, hey, that makes sense. If you take the stocks that have gone down the most over the last 5 years, of course you're going to make money over the next 5 years. Well, couple of things this seems like a very simple strategy to put in practice, right? All you have to do at the end of every year is buy the 50 stocks that have gone down the most over the last year, buy them and hold them for 5 years. Here are a couple of things to watch out for. While it's clear that the loser portfolio beats the winner portfolio across if you look at the entire portfolio, there are some warning signs in these portfolios. If you look at the loser portfolios, a disproportionately large number of those stocks, because they're the biggest losers, trade at low stock prices. You might say, so what? What if they trade at $2 or $3 or $4 per share? Well, remember the studies on transactions cost. When you buy stocks with $2, $3, $4 per share stock prices, you have much larger transactions costs in terms of the bid-ask spread, in terms of price impact. So if you take into account those transactions costs, they start eating into your returns. In fact, one study did a very simple adjustment to the DeBond-Taylor study. What they did was they put a floor of $5 on the stock price. They said, we're not going to buy any shares that trade at less than $5. If you did that, a big chunk of those additional returns you saw on that previous chart disappear. There also seems to be a strange timing effect, which is if you buy loser stocks every December, as DeBond and Taylor did, you make the money. But if you buy them in June, you don't make as much money. So there seems to be some interplay with the January effect we talked about and the loser portfolio. Maybe there's a story with the tax loss selling that can explain it, but that's something to keep in mind. So if you're creating a loser portfolio in March or April or June or July, the effect is not as significant as creating it right at the start of January. And the third factor, and this is worth repeating, is even the DeBond-Taylor finding, which is the most attractive, the most optimistic finding of all the studies that have looked at loser stocks, looks at a 60-month time horizon. You're saying, so what? Well, if you plan, how many investors have a 5-year time horizon? Most investors have 3, 6 months, and even those investors who claim to have a 5-year time horizon often tend to lose patience a lot sooner. Saying, I wouldn't lose patience. Well, would you? Let's take a look. In fact, if you look at the returns on the loser and the winner portfolios and you track them by month, it turns out that the holding period matters. That if you look at the winner minus the loser, that initially, so the way to read this is this is the difference between the winner and the loser portfolio. For the first 12 months after you buy these stocks, the winner portfolio actually outperforms the loser portfolio, which is the opposite of what you saw overall. It's only as you start tracking this portfolio for a longer time period that you see the loser portfolio eventually. So the number has to go below the line. So basically, it's only as you start adjusting for time that you start to see the loser portfolio eventually win out. So here's what's going to happen. You're going to buy these loser stocks based on these studies. 12 months into the portfolio, you're going to look at your portfolio, and guess what? Your loser stocks would have dropped more over the next 12 months, which actually is consistent with the momentum studies over shorter time periods. It's only then that the reversal kicks in. That's why patience is such an integral part of making money of these loser portfolios. So that's the first set of contrarian studies. Good evidence on the face of it, but if you dig a little deeper, you can see the reasons why so many people have a tough time sticking with this loser stock portfolio strategy. Here's a second contrarian strategy. Rather than be built around what's happened to the price, you build around the reputation of the companies. You know how the old saying goes, right? Buy a good company, don't worry about it. Over time, it'll become a good investment. I'm going to reverse that advice. If you look at the evidence, there's actually some evidence that suggests that the best investment strategy is to buy bad companies, not good companies. Let me step back. There's a big difference between a company being a good company and a company being a good investment. Bad companies can be good investments, and here's why. When you have a good company and everybody recognizes it as a good company, that gets built into the price. Your reputation becomes part of your price. If you're a bad company and everybody realizes you're a bad company, your reputation gets built into the price. So when you buy a stock at a price that already reflects your reputation and you're a bad company, you don't have to do much to beat expectations. Your expectations have been set so low that delivering above expected results becomes easier to do. So there's an argument to be made that companies that look bad in the way they're managed, have bad press, basically are bad companies, could be good investments because you're much more likely to see above expected numbers from those companies. In fact, there's a very interesting study that looked at Tom Peters two decades, maybe 3 decades ago. There's a very famous book on excellent companies. And essentially he characterized what makes excellent companies: good management, flexibility. So he had a series of factors he looked at to classify companies as excellent companies. And if you flip these factors on their tail, you got unexcellent companies, companies that did the exact opposite. So there was a study that actually looked at excellent versus unexcellent companies. The excellent companies meet every threshold for being good companies. The unexcellent companies do the exact opposite. And this study actually looked at which of these two groups would be a better investment, and at least for short time periods. This study actually found that the unexcellent companies beat out the excellent companies. And actually, the person who did the study revisited the study, and after controlling for other things, turns out that the two companies, it's the differences start to disappear. But even in the best case scenario, the excellent companies don't deliver higher returns than the unexcellent companies. But the intuition again is very simple. It's not because they're bad companies, but because the expectations get set too high. The expectations game is a very tough game to win. So here's the essence of success in contrarian investing. First, when you're a contrarian investor, you're buying when everybody else is selling. You're selling when everybody else is buying. You better have enough self-esteem and confidence to be in the face of the crowd. It's easier said than done. That's why there are lots of contrarian investors on paper, relatively few in practice. Second, if you're managing other people's money, let them in on the secret. Let them know you're a contrarian investor, and they need to have enough faith in you to ride with you. Because remember the loser stock study, for the first 12 months after you bought those loser stocks, they kept going down. You need investors who stay with you through those 12 months, either because they trust you implicitly or because you've delivered enough returns for them in the past that they know you can turn it around. Third is you need patience. Patience is not something you can tell me you have to show me. Basically, you have to do it. You have to walk the walk, which means you got to hold on to these loser stocks through some bad times and bad press and clients asking you, how the heck did you justify buying that stock? Fourth, for the short term, you need to be willing to live with some volatility. Your prices will probably swing around. Your paper portfolio is going to have big losses. You got to be willing to live with that, at least in the short term. And finally, watch out for transactions costs. Many of these loser investment portfolios, because the prices of these shares tend to drop to a point where the transactions costs start to mount up, and maybe even the trading volume starts to dry up. You got to watch out for transactions costs. But contrarian investing, I think, has a solid basis in reality, a solid basis in if you look at the empirical evidence. The biggest, I think, barrier to good contrarian investing is you. You as an investor have to be willing to go against the crowd and believe in yourself, and that's easier said than done. But I hope you've enjoyed this session. Thank you very much for listening.